target date and life cycle funds is
Yep.
a topic of conversation quite recently. For those that don't understand that and how best to approach it, can you give us a simple explanation?
So target date or life cycle funds or age target funds, whatever you want to call them, it's essentially a standardized investment approach that a lot of pension providers will have in the UK or in the US, for example. And it's where you tick a box and say, I think I'm going to retire at the age of 65. And it's a multi-asset structure or multi-asset type fund whereby the closer you get to retirement or your target date, we should say, the asset allocation moves away from risk assets, so equities more into government bonds, corporate bonds, money markets. So effectively de-risking and locking in the growth that you've achieved in the earlier days. In principle, they work very well for some people, but not for everybody. I think they're quite assumptive and just assuming that the pension is somebody's only asset for retirement, whereas realistically over a long period of time they might build up assets around that, so they might not want to de-risk as they move closer towards retirement. I've come across quite a few clients recently where they're in a stakeholder pension, a target date fund, and they've not reviewed it for a while. They're 2 or 3 years away from retiring, and they're saying, well, why am I only receiving a sort of a 2 or 3% return when I've actually got a moderate growth or a growth-based attitude to risk? And the reason for that is because and they've missed out on, the S&P doing like 20, 30% over the last sort of year and a half. That's kind of how a life cycle fund works, but they don't really work very well for everybody. So it's kind of important that people review that basically.
And the other consideration, especially if you look at clients that are here in the GCC, most individuals move to the GCC due to the opportunity, and what that opportunity allows them to do is perhaps retire 5-10 years earlier than 65 or 67, which is the normal retirement date currently in the UK. So again, looking at the underlying asset allocation, is that in line with your retirement goals and your retirement expectations? I believe is really important, rather than it just being in the default option. It's quite rare that people want to just be in a default option. And a lot of people think about the markets, and some people, they understand that depending on where you're invested, you could get different types of returns from a geographical location and also from an asset allocation standpoint, but it's helping educate people to understand, is that what you would like, or would you prefer to have a bit more control, flexibility in terms of where you evidently invest your funds, which you've worked very hard for, and over a 20-30 year career, it's a pretty sustainable amount of time. And like Tom said earlier, the majority of the people that we deal with, their pensions are typically their second or third largest asset other than their property or investment properties, and disregarding it for years and years probably isn't the most sensible of things to do. And a review only takes a couple of meetings, a couple of hours of their time that they would invest into that. So yeah, it's quite a sensible and wise thing to do, I'd say.